For decades, U.S. Treasury bonds have been the foundation of the global financial system. Countries worldwide, particularly economic giants like Japan and China, have invested heavily in these bonds, seeing them as a safe and stable asset. These investments not only helped finance the U.S. government, but also allowed these nations to manage their own economic stability. However, recent reports have surfaced, suggesting that Japan and China have sold nearly 45% of their U.S. bond holdings, sending shockwaves through financial markets. Is this a coordinated effort by East Asian powers to weaken American influence, or is there a more complex economic rationale behind this decision? More importantly, what does this mean for the future of the global financial system and the dominance of the U.S. dollar? Let's break it all down. The U.S. Treasury bond market has long been regarded as a pillar of global financial stability. These bonds provide the U.S. government with essential funding to cover budget deficits and finance key projects. In return, investors worldwide benefit from the perceived safety of holding U.S. debt, given the dollar's status as the world's primary reserve currency. Historically, Japan and China have played a crucial role in this system, at times being the largest holders of U.S. debt. Their investments ensured steady demand for Treasury bonds, keeping borrowing costs low for Washington. But as the global landscape shifts, so do economic strategies. Several factors have led Japan and China to rethink their reliance on U.S. Treasury bonds. While both nations have their unique motivations, common themes such as geopolitical tensions, economic shifts, and financial prudence play a key role. China's bond sell-off aligns with its broader strategy of reducing dependence on the U.S. dollar. Over the years, Washington has imposed trade restrictions and tariffs on China, prompting Beijing to reconsider its exposure to American financial instruments. The Chinese government has long understood that its reliance on U.S. assets puts it at a disadvantage, particularly in the event of a financial standoff. To mitigate risks, China has been actively diversifying its foreign exchange reserves. Instead of pouring capital into U.S. bonds, Beijing has been increasing its holdings in other currencies, gold, and strategic investments worldwide. By doing so, China aims to insulate itself from potential U.S.-imposed financial sanctions. Unlike China, Japan is a close ally of the United States. However, Japan's decision to sell U.S. bonds stems from domestic economic concerns. The Japanese economy has struggled with stagnation, rising public debt, and the effects of global inflation. For years, Japan's central bank maintained a policy of monetary easing to stimulate economic growth. However, as inflationary pressures mount and exchange rate fluctuations impact Japanese businesses, Tokyo has been forced to rethink its financial strategies. Selling U.S. bonds helps Japan stabilize its own currency and reallocate resources toward domestic economic recovery. The timing of Japan and China's U.S. bond sales raises the question, is this a coordinated effort to challenge American economic dominance? While it is tempting to assume that these two Asian giants are working together to undermine the U.S., historical rivalries and political tensions suggest otherwise. Japan and China have long-standing territorial disputes, conflicting geopolitical interests, and vastly different diplomatic approaches to global affairs. However, financial markets operate on pragmatism rather than ideology. Even without explicit coordination, Japan and China's simultaneous decisions reflect a growing trend of nations seeking alternatives to the U.S.-led financial order. Whether intentional or not, their actions send a clear message to Washington. The world is no longer willing to rely solely on U.S. financial instruments. The immediate impact of large-scale U.S. bond sales is increased volatility in financial markets. If major holders like Japan and China dump their bonds, prices fall, and yields, interest rates, rise. This makes borrowing more expensive for the U.S. government and could lead to significant economic consequences. Higher interest rates would drive up the cost of servicing U.S. debt, potentially exacerbating the already massive budget deficit. Additionally, if the dollar weakens as a result of reduced foreign investment, inflationary pressures could intensify within the U.S. economy. To counter these risks, the U.S. Federal Reserve may have to adjust its monetary policies, either by raising interest rates or engaging in diplomatic negotiations to reassure bondholders. This development raises fundamental questions about the future of the global financial order. If major economies continue reducing their reliance on U.S. Treasury bonds, it could mark the beginning of a shift away from the dollar's dominance. Several countries, including Russia, India, and even European nations, have explored alternative reserve currencies and financial systems. The rise of the Chinese yuan, digital currencies, and regional trade agreements further underscores the growing desire to reduce dependency on the U.S. dollar. For decades, the U.S. has benefited from what some call an exorbitant privilege, the ability to print money and finance deficits without facing the same risks as other countries. But if more nations follow Japan and China's lead, Washington may find itself forced to adopt stricter fiscal discipline to maintain investor confidence. Will Japan and China continue selling off their U.S. bond holdings? Or is this merely a short-term adjustment? The answer remains unclear. If this trend continues, the U.S. may need to rethink its economic policies, focusing on reducing debt dependency and fostering greater domestic financial stability. Strengthening alliances outside of Asia, encouraging domestic investment, and addressing structural economic weaknesses could all become key priorities for Washington. Meanwhile, Japan and China's actions serve as a wake-up call to global investors. The assumption that U.S. bonds will always be the safest investment is now being questioned. As financial markets adapt to these shifts, new economic alliances and monetary strategies may emerge. The decision by Japan and China to sell a significant portion of their U.S. Treasury bonds is not just an economic maneuver. It is a geopolitical statement. While there may not be an explicit alliance against the U.S., their actions highlight growing global concerns about over-reliance on American financial instruments. As the world watches these developments unfold, one thing is certain: the days of unquestioned U.S. financial dominance may be coming to an end. Whether this shift leads to a more balanced global economy or increased economic instability remains to be seen. What do you think? Is the global financial system undergoing a transformation, or will the U.S. find a way to maintain its dominance? Let us know in the comments below. And don't forget to like, share, and subscribe for more in-depth analysis on global economic and political trends.